With a quality mall comes a quality roof, ready to protect SCG against its structural and cyclical storms. We issue buy guidance for Scentre Group at a target price of $364, founded upon three key investment pillars. First, SCG's demonstrated resilience in economic downturns, a derivative of their solid tenant occupancy structure. Second, we believe SCG can leverage the Westfield brand, underpinned by a connected, defensible, and integrated property portfolio. And finally, the inherent capacity of SCG's development and construction arm to drive visitations. SCG is Australia's largest retail property firm, operating 42 Westfield centres across Australia and New Zealand. In our national survey across 3 Australian states, it became evident that these centres lie at key consumer junctions, with 54% of respondents noting location as their primary reason for visitation. With a robust value chain comprised of property, management, and construction revenue streams, SCG is highly insulated in a pessimistic market. The pandemic disrupted both supply and demand levers for retail property operators in Australia, with restrictions greatly hindering in-store visitations. SCG's recent skew to a more service-based tenant offering drove visitations during this period and naturally tenant demand. As such, this newfound reluctance for lease renewals bypassed SCG, being the only firm among competitors such as Vicinity and Charter Hall to increase occupancy rates immediately after restriction easing. Of further note is the increasing shift towards online shopping, as housebound consumers flush with government stimulus and unspent holiday funds catalyse the upswing in e-commerce. However, SCG has dynamics at play to remedy this revenue diversion. Strategic collaborations with entertainment icons are driving the experiential experience, buttressing visitations in the short to mid-term. Of note, SCG has outperformed the A-REIT ETF for the last 3 years, with no sign of slowing down. I now pass to Liam to cement our first investment pillar.
Thank you, Hugo. SCG operate a diverse portfolio of over 11,900 tenants and 3,600 retailers, of which a significant 60% of gross leasable area are attributable to anchor and specialty stores such as Coles, Woolworths, and JB Hi-Fi, all 3 being listed on the ASX. These stores have strong credit ratings, reducing the probability of rental defaults, ensuring stability during periods of increased interest and rental rates. Despite SCG's inflation-linked rental escalation of CPI plus 2%, which has caused rents to increase by around 27% since 2020, occupancy costs remain reminiscent of pre-COVID levels at 16%. This suggests that SCG's tenants have the ability to offset these additional costs by passing them down to their clientele, highlighting the strengths of their underlying tenant mix. Additionally, SCG's specialty weighted average lease expiry of 7.7 years is noticeably above industry average. This reduces exposures to the negative leasing spreads that may be induced by macroeconomic downturns. Now moving on to the next thesis point. We expect the rigidity of SCG's demand to position them favorably compared to their peers as the pressures from online retailers mount. This allure to tenancy choice is driven by the Westfield brand name along with 2 main advantages. Firstly, SCG's highly desirable shop fronts gives them the ability to dynamically alter their tenant mix. Attributable to a first-mover advantage dating back to 1959, SCG now operate a $35 billion portfolio at the doorstep of Australia's wealthiest. Secondly, SCG's recent venture into the digital realm through Westfield Plus adds significant connectedness between centres. Now servicing 3.8 million members, a remarkable 600k increase from the previous year. This mobile-based program has several benefits, including information about centre events, maps, and exclusive offerings. We'll now be discussing our construction and development pipeline.
Thanks, Liam. SCG's approximate $4 billion development pipeline drives visitations, a key part of our value chain, through increasing Westfield's experiential offerings, which were identified in our in-house national survey as the 3rd most common reason for choosing Westfield over alternatives like online shopping. For example, The Westfield Knox development, which saw the addition of an outdoor kids' play space and a full-size basketball court, had visitations rising by 13% following completion. With the target incremental IRR of 12 to 15%, significantly higher than our 9.1% cost of equity, this development pipeline is highly value accretive. SCG's in-house construction arm further ensures style consistency and quality of development, with more control over timelines and capex costs, achieving a superior IRR. Although this clearly reinforces competitiveness, SCG is currently trading below historical averages, indicative of a material mispricing. So, how is SCG tracking along with ESG? Within the environment pillar, SCG secured 100% renewable energy across its New Zealand and Queensland portfolios, with new long-term energy agreements in New South Wales and Victoria. Solar installations have also been completed at various centres such as Westfield Tuggerah and Westfield Hornsby. This will ensure target net zero by 2030, supported by a track record of hitting targets well ahead of plan, such as receiving a 4.5-star energy efficiency rating 3 years early. Within the talent pillar, SCG ensures employee retainment by fostering a healthy and diverse workplace, most recently introducing new life leave, wellbeing platform, and an ambition forum hosted by the CEO to gather employee feedback. Recently, they also achieved a gender ratio of 40 males to 40 females to 20 of any gender, with 54% females across all levels of management. Lastly, SCG's economic performance is backed by a highly motivated and expert team. Around 70% of board members are considered either expert or advanced in skill sets varying from financial acumen to retail engagement to people and culture. Executive remuneration is also linked to SCG's responsible business framework, with the return on capital employed hurdle increased from 60 to 70%. This drives a virtuous cycle of ESG-linked long-term value. Now let's discuss our valuations.
Thanks, Jen. Now, ultimately, the factors we've discussed throughout this presentation have been distilled into a target share price of $3.64, implying a positive margin of safety of 15.5%. The blended valuation methodology includes a relative valuation and a discounted FFO, but it relies predominantly on an unlevered free cash flow and net asset valuation. The unlevered free cash flow is assigned the greatest weighting, considering it is a pure form free cash flow derivation and is therefore most representative of the intrinsic value of a company. The key drivers for this model were rental expectations and the discount rate applied. On the other hand, the net asset valuation model is most sensitive to the capitalization rate assumption. We've applied a weighted average cap rate of 5.7% to forward net operating income, assuming a historical spread over real bond yields to consider the impact of both changes to nominal yields and to rental expectations, which are tied to the inflationary environment. We've also implemented a scenario analysis considering a bull and bear case. The bull case produces a positive margin of safety of 41%, whilst the bear case produces a negative margin of safety of negative 8%. The bull case considers the impact of an economic soft landing, while a bear case considers the impact of further rate increases and a significant deterioration in the brick and mortar retail landscape for SCG. So what are the key risks facing our valuation? Well, there are two that I want to touch on here in particular. The first is of higher real yields driving further cap rate expansion, and the second is of a hard economic landing characterized by a low inflation environment. Speaking to number one first, the reason we haven't seen capitalization rate expansion to the same level as nominal yield expansion is because of the inflationary environment we see ourselves in, and therefore the high rental expectations. And that's important as it provides SCG a degree of protection in a low inflation, low rates environment and a high inflation, high rates environment. But it does leave it particularly exposed to a low inflationary environment in which rates remain high. And that takes me to that second key risk of the economic hard landing, in which we see tenants under increased pressure to meet rental obligations and lower inflation-linked rental growth for SCG. So, to summarize, we are initiating buy coverage for SCG, and that's based on our assessment that the firm is better positioned to withstand structural and cyclical headwinds than the market has anticipated.
Hi, I'll start first. You have a slide on your blended valuation method. In terms of the weighting, can you probably explain and justify how you weighted the various valuation methods?
Yeah, thanks for your question. So we predominantly focus on that unlevered free cash flow because ultimately it's most representative of the intrinsic value, calculating those free cash flows forwards and assuming a cost of debt based on yields to maturity for SCG government bonds. The net asset valuation was used and important because it does consider the impact of nominal yields and inflationary expectations on cap rates. So we've used real bond yields to forecast that net asset valuation, and still a really useful metric when valuing a retail company in particular, a retail mall. The discounted AFFO gave us some insight into the impact of rate forecasts on valuations because it is a levered methodology, but ultimately it's not directly representative of free cash flow, and therefore we assigned a 10% weighting. When it comes to the relative valuation, it was assigned a 10% weighting because it does provide a consideration for the market, but there is uncertainty in markets and it limits the value of that method. And on top of that, the comparables are not necessarily directly relevant to SCG.
Thank you very much for your presentation. I really appreciated the coverage of the tenants. I do want to ask a question, be mostly focused around slide 10. You had mentioned that there is a diverse tenant mix, which this certainly does show. However, there is a pretty big concentration when you look at some of the dining, health, beauty, and fashion, a lot more of those in-person services, some to a degree going online. So could you maybe talk a little bit about the risk, within the underlying tenant risk and how that contributes to your valuation?
Yeah, that's a great question. So if you can go to the tenant mix slide here. Sorry, I'm just going to step forward here. We can see that, yes, there is a certain concentration in certain stores. There's no secret about that. As we can see here, I've actually pulled the 5 stores with the highest concentration in fashion, for example. I think this provides a great representation of the tenant mix, and at least the mix unique to Scentre. Why I've pulled out this is very interesting. Is very interesting to see because we can see with a higher concentration of fashion, we see a higher average household income. So what we've seen Scentre Group do with their Westfield malls is that they position them they tailor their tenant mix towards where they are positioned and their demographics surrounding them. It's no secret there's a 20% greater average income within a 30-minute drive of the average Australian income in areas with higher fashion, which is known as a more exclusive offering and something that is more catered to the higher income demographic. So in terms of that, we are seeing Scentre Group strategically fill their stores with specific industries that cater towards a tenant mix.
Coming back to the business model, consumers' behavior changes, and we could see during COVID. Now we have a certain rebound, but definitely there is a change going on. We are becoming more and more online, and some services might not be actually used on site, at least to that extent. How do you see that risk? How you see the risk that some of the tenants may actually face problems because these services will in some time no longer be provided on site, online instead?
Yeah, no worries. I'm happy to take this question. It's a fantastic question and something we certainly did incorporate into our valuation. So, Alex, if you could please move to e-commerce overview. So given this is a global final, I want to provide a bit of context between the e-commerce market in Australia versus the e-commerce market overseas. So it is still actually quite a nascent industry within Australia. It doesn't have the same ubiquity and infiltration as what you might expect in the US with same-day delivery. However, it is correct. It is an absolute risk, but it's not only at the forefront of our minds, but also the forefront of SCG management. So Alex, please move to C1. So what we harped about on rather extensively within our main body is the positioning of the experiential offering, essentially rapidly altering their tenant mix to provide services that aren't actually replaceable by online shopping. The way that they're able to do this is the highly desirable shop fronts. It allows tenants to want to have their brand on the shops within these stores. The second is the Westfield Plus app, providing a sense of connectivity and integration, providing exclusive offers that aren't available online to our consumers. The third and foremost is the development and construction arm. Allows them to rapidly alter how their shops actually look and meet the consumer needs at the time. Now, this is all great, but Alex, if you could please move to A9. We actually saw this with ourselves in our in-house national survey. So our team members went to 3 of the most capstone properties within Australia and surveyed consumers. Although incredibly traumatic, it was an unbelievable experience in providing insight into our valuation. So we can see that 45% of people were actually there for something other than shopping, a true testament to the positioning of that experiential focus. When we specified and got more granular, you can see that 10% were there for the experience, or roughly 11, over 7% that were actually there because of incompatibility with online shopping. So that's the result.
Yeah, I might just add on to that. So in terms of what they've actually done so far, Alex, could you please go to D4? So just a statistic from their most recent report, around 44% of their leasable area is related to experiential offerings. And we have a couple examples up here. So at the Mount Druitt Westfield Shopping Centre, they've got a new rooftop dining, indoor children's play area, and green spaces. And this has contributed to a 37% increase in visitations, which flows through to revenue and their financial performance. And then I alluded to earlier, the Westfield Knox development. So they've currently completed the basketball court and the outdoor kids play space, and incoming there's a swim school and a community library, and essentially that increases foot traffic for the tenants that are inside their malls and makes it more of a value add for these tenants.
Thank you. If I may, you mentioned that the company is quite strong regarding ESG. My question regards ESG and is the following. What aspects, in your opinion, will have the most impact on company results and valuation, and through what channel it would be? Hint, no marketing, please. Your opinion on influence from ESG on valuation, ESG on results.
Yes, that's a very good question. Yeah, ESG is a very big rising trend in Australia as well. If you could please go to E3, please, Alex. So we believe that the arena that would most affect SCG's financial results is probably most related to the environmental side. So in Australia, we are we're becoming more eco-friendly, and if SCG didn't basically hit their targets and be held accountable for what they say they would do, this would most likely decrease visitations, which would negatively impact the revenue and their financial performance. However, we can see here that SCG has a very strong target of hitting net zero Scope 1 and 2 emissions by 2030, which is 20 years ahead of the Paris Agreement. And they are well on track for this due to their solar installations and their 100% renewable energy agreements. So generally, in terms of how ESG will affect the financial performance of SCG, we believe they are very well positioned because they have such a strong performance and they're able to hit all their targets within the environmental area.
From a social perspective as well, what's really interesting and important with SCG is that they have been focusing those developments on bringing communities together. So the social aspect as well is something, especially during COVID in Australia, we had strong lockdowns and were not able to socialise and meet with people. Even in our national survey, there was a surprising amount of people that just said they were coming to centres to pass time or spend time with friends. So from a social perspective, getting more people through stores by creating a community centre then flows through to increased visitations, which improves lease bargaining with tenants, then receiving higher sales as well by bringing people into stores. So that's an important aspect from an ESG perspective.
You have inflation in Australia actually proving to be stickier and stronger than expected. What kind of interest rate scenario or in terms of RBA hikes are you factoring into your target prices?
Yep, thanks for your question. I'll take that as well. Okay, well, firstly, what's most important, because we are using predominantly an unlevered free cash flow analysis, is the cost of debt. I'll pass to Liam to discuss briefly that, and then I'll go back to some of our explicit forecasts.
Yeah, so if we look at our cost of debt breakdown here, we can see that we use a blended methodology with a predominant weighting on our weighted average yield to maturity. So Alex, if you could please switch to the slide Bloomberg YTM at the very end of the appendix. We were lucky enough to have access to the Bloomberg terminal where we were able to find current up-to-date yield to maturities of all Scentre Group outstanding bonds. As we see cost of debt being a forward-looking measure, we put a reduced weighting on the backwards-looking interest liability coverage ratios that you typically see. Given we have up-to-date yield to maturities, we're able to essentially provide the most accurate interest rates that are currently affecting Scentre Group bonds today. I'll now pass it back to Alex.
Yeah, and very quickly on the explicit forecasts, which we've used looking forward, we've assumed a high for longer rates environment and essentially market pricing.
Two-part question here. First, you mentioned that you feel like the current stock is undervalued. So talk a little bit about what you think. Why is it undervalued? And then secondly, as I looked at some of the spreads on your valuations, it looked like there's a fair amount of potential upside based off of this. So I guess how did you land at the base case that you landed at?
Yeah, fantastic question. So I'm happy to take the first part regarding what does the market miss currently. Then Alex will talk about our assumptions, particularly our conservative nature moving forward. So Alex, if you please go to A1. Fantastic. So we asked ourselves this question several times over. It seemed like a high quality stock. We were wondering, why isn't everyone buying? There were really three key reasons in the short term that came out as quite salient. So the first being SCG and the retail market being heavily discounted as the threat of online shopping looms. So we essentially thought there was, given the infiltration, as I alluded to before, in the US, we thought a lot of that perception had actually transcended into the Australian market as well. The second point is SCG's share price remained depressed in the wake of COVID-19. So as Alex alluded to before, lockdowns in Australia were incredible. I think Melbourne was the most lockdown city in the world for back-to-back. So we believe that also had a lingering effect. And finally, something that actually came out of an independent MSCI report was the downgrading of their ESG. This was to do with retention rates, but SCG rapidly jumped on this and included several new retention plans to increase this moving forward. So it was a combination of those things. And I'll now pass to Alex to talk about how that was incorporated into our assumptions.
Yeah, thanks for that, Hugo. So when it comes to the property revenue growth assumptions, we do see or believe that our assumptions are relatively conservative, particularly on CPI. We're gradually returning to 3%. CPI is obviously an important factor in our valuation because 80% of leases are CPI linked with CPI plus 2% leasing structures. Now, for those leases which are ending and moving on to new leases, you can see there the contract churn line on number 5. That's the percentage of leases rolling over. We've assumed a leasing spread. Now, historically, these stocks have maintained, particularly SCG and Vicinity, which are high quality retail stocks, have maintained negative leasing spreads because of their strong leasing structures. We forecast a return towards those negative leasing spreads, even though there is necessarily a significant catch up in leases, with leases during COVID seeing strong negative leasing, and then we could expect further normalization in years to come.
You mentioned on one of your slides that e-commerce in Australia is pretty much still in its nascent stages. On impact to REITs, do you think current valuations would be the new normal going forward?
Yeah, fantastic question. I think, look, regarding in its nascency, the reason for that is, I'm not sure how many people here have been to Australia, but it's ginormous. So getting one parcel from one place to another is incredibly difficult. So there's going to have to be some significant improvements with regards to logistics planning and delivery to have e-commerce really have its hold on society. In terms of whether this is going to be the new norm, I think what's really important to differentiate is the experiential focus of SCG. The difference being they're not trying to, I guess, have those direct sales, but it's foot traffic that are getting people through the door. I think a second point to think about as well is the difference between, or the coupling between an in-person store and online. I'm not sure about yourself, but I love to go in and try things. And unfortunately, VR is not at the stage where you can kind of get a whole fit on at the moment. So it's actually a unique dynamic between online and in-person, where they need the in-person so that people can have the experience of trying things on.